Derek, Jess, welcome to the Long-Term Investor.
Hey, Peter. Thanks for having me.
Today, we're going to be talking about executive compensation plans. And I say executive with emphasis because it's tempting to just go equity compensation. It's really a hot topic, but there's a few things that I think fall into that bucket that truly is more executive compensation. And so, Derek, we're going to dive right in so we can cover some of the basics of some executive compensation and then get into the nitty-gritty of how you and others at Plancorp are integrating that with portfolios and into a financial plan. I was thinking that because we are intentionally calling this executive and not equity comp, maybe we could start just with deferred compensation plans. What are they and how do they work?
Yeah, so this is something that, maybe you don't have to be like a C-suite executive to have one of these, but just generally very highly compensated employees. It's the ability to defer far beyond limits with pre-tax dollars, you could say with an IRA or a 401k, either with a bonus, which is most common. Sometimes you can do it with salary, but it's really less of a compensation type and more of a way to get the most out of your compensation. So you would take a cash bonus or salary and then elect to put a certain amount in a deferred compensation plan to be paid out later instead of today. And the main reason to do that would be for tax planning purposes. They're similar to 401ks in some ways, but they're also really different too. And I'm sure we can get into those today.
Yeah, that would be great. And just to continue on, though, with some of just laying out some definitions and moving into equity compensation specifically, I think it's important just to say, equity compensation is simply compensation awarded to an employee in the form of a company stock instead of cash. And so each award is known as a grant of company stock. The grant date is the date an equity compensation grant is issued by the employer to the employee, and the vesting date is the date in which the employee receives the full control or possession of that equity compensation grant. Derek, you do a lot of work on this type of thing with clients, and since I mentioned vesting dates, maybe you can go through the vesting schedule and the differences there.
Yeah, so when you get an award, you get that grant, you don't have it right away. And so there's a few different ways that can be structured. The two most common that I would see would be a time-based vesting schedule that's either you get like a little bit over time, maybe that's each month or quarter or year for a 3 to 5 year period, or it's called graded vesting, or there's cliff vesting where I get awarded my bonus in the form of whatever. We'll get into the different types of equity comp, but I get it all at once at the very end, right? So maybe I have to stay at the company for 3 years or 5 years before I actually receive any value from those. So that's called a cliff vesting schedule. Beyond that, there's a couple of other ones, more common at the executive level. There could be a performance-based component as well, and this would usually be in tandem with time-based. So still, have to wait 3 years until I get it, and there has to be some sort of company metrics that are hit. Maybe that's tied to stock price or profitability. The formulas there can get very convoluted, but usually tied to the business overall and the stock price, and maybe even to the specific performance of the individual. If that hits, those are typically would be like a multiplier effect, or, half of my grants are time-based and the other half of this particular grant I get if these performance-based metrics are hit too. And then something you'd only see in the private space would be something that's a liquidity event-based vesting. So, if you're a private company that's looking to IPO soon or hoping to get acquired by a private equity firm or just a larger company, none of what I get would vest until that merger, acquisition, IPO happens, and then at that point, I'd get it. And so those are often also in tandem with time-based. They're called double trigger vesting, to where I've got to do my time-based and the company has to go public or be bought in order for those to actually come into my possession and have any value to me.
And Derek, you sometimes will joke that people come to you knowing that you have so much knowledge on this topic and say, hey, I got these stock options. And they mean that so broadly, and maybe that they aren't actually stock options. So maybe we can start by talking through the basics of restricted stock and then stock options. So let's start with restricted stock. Maybe give us a high-level overview of what that is.
Yeah, that's a great place to start. Restricted stock is more common or more closely related to what most would understand as cash compensation, except instead of cash, you get company stock at some point in the future. So as a simple example, if I've got a target bonus of $300,000 and maybe that's supposed to pay out to me in 3 years. So we'll call that a 3-year cliff vesting schedule. I get it all 3 years from now. Instead of $300,000 cash that I get 3 years from now, I would get $300,000 being the target amount. And let's say that the price of stock at the company I work for is $25 a share. Instead of getting that cash, I'd be awarded 12,000 shares of company stock in the form of restricted stock units or restricted stock awards. Those are very similar. And what that's going to be worth 3 years from now could be a lot more or a lot less than 300,000. It's tied to a specific number of shares that I was granted. So that target is at the date of grant, and then what happens between then and whenever they eventually vest. That's very much up to what the price does for company stock.
Well, and so that's restricted stock. What about stock options? I mean, there's probably a few more moving parts that people need to understand there, right?
Yeah, so whenever you have a stock option, even when it vests, I actually don't own anything yet. Instead, you own the right to buy stock at a previously agreed upon price. And again, that's usually tied to whatever the price was on the date that was granted to you. And so if it was $25, like in the example I had last time, I might have 36,000 options as an example. If my bonus target is $300,000 at $25 a share. And let's say I get 3 years down the road, those have completely vested. I don't have anything until I exercise that option. So this is one of the kind of key terms to know. When you exercise a stock option, you're saying, hey, I have the right to buy this at $25 a share. The price is currently $100. I'm going to exercise my right to buy stock at $25 a share. And at that point, it becomes taxable, and we can talk about taxation here in a bit. And then I would acquire the shares. And there's 3 or 4 different ways that you can go about exercising that. But you don't own anything until you exercise. And if you leave the company, retirement, or you get another job, or these have expiration dates. Usually it's about 10 years from the date that it was granted, but sometimes they can be much shorter. If you let this lapse, your option lapse, and don't exercise, then you lose the ability to do that. So then any value that you could have captured there is gone. So it's really important to know what is the expiration date of my stock option, and are there circumstances that would lead that to be something different? And I can assure you the answer is yes. So there's special rules. If I leave, maybe I have 60 or 90 days to exercise my stock option, and at that point it expires instead of in 2028, like it said in my grant agreement. So it's really important to know those things. You'd sure hate to have it lapse without you exercising and miss out on potentially a substantial amount of wealth.
And taking this one layer deeper, people have non-qualified stock options. They have incentive stock options. What are some big differences that you feel like people should be aware of? Because again, sometimes just people know they have some sort of equity compensation, but there are pretty substantial differences in the taxations of those.
Yeah, that's where the difference lies, is how they're taxed. So with a non-qualified stock option, whenever there's no taxable event that happens at grant. There's no taxable event that happens as those options vest, regardless if it's time-based, performance-based, anything like that, because I haven't bought anything yet, and I could still lose it, right? Like if I don't exercise the option, there's no value, and that's kind of the key trigger for the IRS is when is that risk of forfeiture gone? And at that point, that's whenever there's a taxable event. So with a non-qualified stock option, when I exercise that option to buy shares worth $100 and I buy it for $25 because that's what my strike price was, that discount that I got effectively of $75, all of that is taxable as ordinary income, and it's wage compensation, right? So subject to Social Security tax up to the Social Security wage base, and then Medicare tax too, and perhaps the additional Medicare tax. And then at that point, you own the stock outright as if you had just purchased it on the open market, and the same kind of rules apply. Hold it for 12 months and a day, and any gain or loss is long-term, and if you sell before then it's short-term. With the incentive stock option, there's actually no regular income tax due whenever you exercise it, but there's this other phantom tax calculation that goes on in the background called the alternative minimum tax that you have to be aware of. So although for regular tax purposes, we'll ignore AMT for a bit. When I exercise, say it was a 25 grant, that's my strike price. I buy for 100 and then I later sell for $150 a share. No regular tax due when I exercise. And then whenever I sell at 150, that full $125 gain there is all long-term capital gain, assuming I do this in what's called a qualifying disposition. So I've held on to the shares for more than 24 months since the grant date and more than 12 months since I exercised my option to buy the stock. If you do that, then you get this preferential treatment of capital gain on the whole thing. Well, remember back on non-qualified stock options, when you exercise that initial discount of between $100 and $25, that's all ordinary income. So that's a better deal, right? Capital gain rates tend to be, they're always lower than ordinary income. And so that's what makes ISOs so attractive, except at some point Congress decided and the IRS decided, well, that's a really sweet deal. So we're going to add this whole AMT thing to that, to where it's not taxable for ordinary income tax purposes when you exercise, but it does count for AMT. And there's totally different rules and how that calculation goes. But I think the helpful way to kind of summarize it today is that you pay the higher of the two. So if my regular income tax calculation is, a tax liability of $100,000, and if I run all of my income, including that discount on the ISO exercise, and there's a few other adjustments, kind of preference items baked into there. If my AMT calculation is $130,000, I pay $130,000. So it'd be $100,000 regular tax for federal, and then a $30,000 AMT at that point on top of it. And it will come back to you eventually, and we can get into that, but that can really create some pretty substantial cash flow problems if you're not aware that that's coming your way. And especially as we're working with executives, that could have a substantial amount of value in exercising ISOs with a price that's way lower, a strike price that's way lower than the fair market value. And if we're not taking into account cash flow, regardless of all the perfect tax outcomes, that's a problem. And so that's the biggest concern, is a cash flow crunch with AMT. And then eventually getting all of that back, because you would, in the form of an AMT credit. It just takes time. Most of it comes back, or much of it can come back whenever you sell that stock down the road, 12 months and a day or more later. But there's all sorts of considerations. I've got the opportunity cost. I could have been doing something else with that money in the meantime. It might take me 10 or 15 years to get that whole credit back. And that just, that matters. It's more, there's more to it than, well, I'm really just prepaying tax. I'll get it all back eventually. It's like, well, when, and if the price drops substantially from the time that you exercise to when you sell, it could be a really long time. And so it ends up kind of being a sunk cost.
When you're hinting at a lot of the nuances that go into planning around these situations, something that I do want to dig into, but before we move on, there's one last piece of what I'll group as executive compensation, even though there is an equity component to it, which is employee stock purchase plans. Not necessarily compensation, but certainly a really good benefit that both executives and non-executives at some companies have access to. Can you give us just a quick overview of that before we dive into some of the planning stuff?
Just to clarify, most so ESPPs aren't exclusively for executives. In fact, if you are more than a 5% shareholder of a company, which if we're talking a publicly traded company, you're really probably a C-suite executive at that point. You actually can't participate in an ESPP, and probably less applicable here, but you also can't, you have to be an employee, so you couldn't be like an outside board member. They wouldn't be able to participate in it either. But the overwhelming majority of people would be able to. And you're right, it's not a form of compensation. I don't receive it through payroll, but you can only get it if you're an employee there. So I just think of it as like a perk, or an employee benefit. And in that sense, the compensation piece is the special discount you can get by participating in it. And so that's why it's often grouped in with equity comp, is because it involves company stock, and it is something that only employees can participate in. So the difference with an ESPP is it's not tied to, it's not W-2 income. It doesn't come through payroll. You actually participate by making contributions through payroll over it's called a purchase period. Usually it's 3 to 6 months, where you're just every paycheck, a certain dollar amount's going in. And at the end of that purchase period of 3 months or 6 months, you then take that, your company takes that cash and then uses it to buy company stock. The benefit there is that there's some sort of discount mechanism built in that can range usually from 5 to 15%. And if it's just the simplest plan with no what's called a look back period, it's just maybe a 5 to 15% discount, whatever the plan rules are, on whatever the price is on the end of the purchase period. So if that's, December 15th, it's just, here's the price, it's $100, you get a 15% discount off of that. There are some plans that have a very valuable feature called a look back provision. So same deal, 5, 10, 15% discount, except instead of just being tied to whatever the price is at the end of that purchase period, it's either that or some date in the past. And this would be the beginning of an offering period, usually 12 to 24 months ago. And so that discount would be applied to the lower of the two. And so if it was $50 at the start of my offering period, and that was, a year and a half ago, at the end of this particular purchase period, now it's at $100, I get a 15% discount on $50 because that's lower. So now really I've got a substantially larger discount than 15%. And that's a really valuable provision. And then if the price dropped since then, no big deal. You still get the 15% discount on today's price because it's lower than what it was. So having that lower of the two deal is a really, really good one. And it can be a pretty valuable benefit. There are some limitations. You can only purchase up to $25,000 worth of stock in any given calendar year. So that's not 25 grand of my own money. It's 25,000 worth of stock. So the amount you can actually put in is the less. And then the company may have additional rules of, up to, maybe they have a dollar amount that's less than that, or, up to 15% of your salary or whatnot. So you've got IRS rules to think about, and then there's going to be some company specific provisions around there too. But this is one of those things that can be easy to kind of write off of I don't really need to mess with that, especially if there's a look back provision there. I mean, you could be leaving some money on the table by not participating in this, especially as you think about it, doing it over 5 or 10 years, 25 grand, potentially substantial discounts. You can accumulate some pretty good wealth here in addition to stock options, RSUs, and other cash components of your comp.
Yeah, it makes for a really nice employee perk. And I think all these things that we're talking about, they can result in, you start building a position in your company stock. And I want to talk a little bit about how someone should think about integrating their company stock with their overall portfolio and their financial plan. But I think we almost have to talk about, before we even do that, just the general risks associated with being concentrated in a single stock. Now, I think owning more than 5 to 10% in any individual stock exposes you to some of the risks that we're going to talk about, but ultimately the risk is even greater when you're an employee of that company because you have a concentrated position in it. And unlike a random investor with a concentrated stock position that could just hurt their portfolio, you are in a situation where a single company can hurt your portfolio and your income. So if your company stock tanks, then your job security and your income are probably going to be at greater risk too. So when I'm in meetings with you, Derek, I feel like people sometimes don't really appreciate how risky it is to own a lot of your employer stock. I mean, I think in general, sometimes people don't realize how risky it is to own a concentrated position, whether it's their employer stock or not. But the data on the risks of owning concentrated positions are really powerful. And way back, I'm looking actually right now. So back in episode 63, I took a deep dive into the question of whether people should own individual stocks at all. And there is a study from JP Morgan that I reference in that episode. I'll link to it in the show notes. I'd like to read a couple stats that I think are pretty mind-blowing on the historical performance of individual stocks from 1980 to 2020, which is when the study's covered. So using a universe of the Russell 3000 companies, which represents a little over 98% of the investable U.S. stock market, roughly 40% of all stocks have suffered a permanent decline of 70% or more from their peak value. That alone is crazy. But then you look at the return on the median stock since its inception versus the investment in just the plain total US stock market or the Russell 3000 index, and that median stock performance versus the Russell 3000 was minus 54%. Now, the same study also found that 2/3 of all stocks underperformed versus the Russell 3000. And for 40% of all stocks, their absolute returns were negative. So I know you've in the past, Derek, shown some data by sector where like, hey, where do these catastrophic losses happen? And they're biggest in energy and tech, which are around like 60% of energy and tech companies experience one of these, which interestingly is where equity comp is most prevalent. But it's honestly, it's really closely followed by the others. I mean, when I look at healthcare, consumer services, consumer discretionary, all around 50%, really everything but utilities has a very high percentage. And most of the time, these catastrophic losses happen for factors outside of management's control. And so I think you and I both have sat in meetings together. We sit in meetings separately where this becomes a big issue. And so I just wanted to make sure that we highlighted that clearly before going into some other key considerations when integrating equity compensation into a client's portfolio or financial plan. So excuse the long monologue here. Anything to add to that? Or, and if not, just go ahead. Why don't you start talking about some of the other things that you think about when incorporating it into a client's plan?
I mean, I love that you just went through that. I the same exact study I'll reference to. I think the point that I would emphasize there is one of the very last things you said is that these are for most often for reasons outside of management's control. You know, people think, oh, well, you know, my company's not Enron. We're responsible and not fraudulent. And so like, that's not going to be a thing for us. This is, you know, currency risk. It's policies and regulations coming out here in the United States or in China. It's, you know, property, you know, intellectual property theft. It's, you know, just there's so many risks involved that are outside of control of even the best, you know, management executive team. And the point of emphasis I want to throw on there is that also means beyond your control too, as an employee. And so I think that it's not uncommon for people to think, oh, well, I'm just going to like work really hard and make a really big difference here. And I'm going to be able to impact the value of my stock from the work that I do. I think it's really hard to make that case unless maybe you're a C-suite executive. Except even then, I would still challenge it because even if you know where the company's headed, you don't know what competitors are doing exactly. And like things can just flip on a dime. Look back at last year, interest rates, you know, the Fed decided, hey, maybe inflation isn't as transitory as we thought it was. And now we're going to be super aggressive on raising rates. When that happens, you know, interest rates go way up. People are less excited to have money in really high growth stocks that are super, you know, not overly expensive, but just it's more expensive to buy $1 of current earnings than say a growth stock than it is say a value stock. And most growth, like tech is growth, like that's a growth stock. And you just saw tech stocks, I mean, plummet in 2022 and, you know, much more than the overall stock market. And there were tons of layoffs there too, just kind of behind the scenes that, you know, I do think it seems like a soft landing is maybe more likely than not. I don't know, but there is no discounting the hundreds of thousands of people that have been laid off in tech last year. And it really came from interest rates, which created crunches that makes it harder to raise capital in the form of markets or loans, whatever. That had nothing to do with what tech companies were doing. And so even if you know where the company is headed and everything just works perfectly according to plan, even if you can master what I just laid out as impossible to predict, you don't know how investors are going to react to that, right? And so it's just not reasonable to think that, oh, well, I can influence, you know, the price of my company's stock and therefore I need to hold on to it because, you know, we're doing great things here. You just don't know. Like progress, you know, economic data doesn't translate directly into market returns. And you've talked about this on your podcast before, Peter. And so it just side tangent a little bit there, but it's something that I really come across a lot as a reason to hang on to company stock.
And I can't help but pile on one more time. And we could probably do a whole episode on all the reasons that you and I hear that people want to hold on to their stock. But I do feel like in 2022 going into it, like late 2021, early 2022, you'd hear people say, well, we just had our investor day and I saw the projection and it's really great. And just a reminder of like, what is stock returns? Where do stock returns come from? They're from earnings growth. They're from cash return to the shareholder, whether that's dividends or buybacks, and they're in changes in valuation. And changes in valuation is this mix of market psychology and calculus that nobody can predict. And it's really like, how much do people really feel like buying your earnings? And so no matter what outlook you have or the company has or how great it is, you are at the whim of millions of market participants on how that third factor, which is so enormous so often, really plays out. So thanks, Derek. I think an important thing to put at the front of how we think about incorporating company stock into a portfolio and financial plan. There are so many considerations. I don't know if you want to go into them in great detail or if you just want to fire off a bunch, but I'll give you the floor and let you tackle it how you see it making sense.
Yeah, I think I can just kind of walk through some, just kind of high level. Let's figure out where you are today, what's going to be coming down the pike, what you want out of your money, what's your comfort level with risk, and then figure out, how does my company stock then fit into all of that in the bigger picture of my plan. So, I do have questions that I kind of work through with new clients and kind of revisit over time. Step number one is figuring out what you have. You'd mentioned earlier, people say all the time, I've got stock options. And my response is always like, do you? Like, I just want to make sure. Can you just send me, send me your grant agreement or, stock plan documents or even your, a statement from E-Trade or, whoever you go through, Fidelity for your, the broker that manages that. Because oftentimes it's RSUs, those are very different. The taxation's different. The mechanisms are different. Like with RSUs, you don't do anything. You just get them when they vest and they're taxable at that time and there's no control. Like you have to know what decisions need to be made, what the tax implications are. And so how much and what types of equity compensation do you have? What are the vesting schedules for each of those? Most of the time, those don't change. However, I did see a fair amount from last year at tech and telecom companies specifically with executives I work with, where they had additional grants on top of what they normally do, just because, I didn't say it directly, but a downside of stock options, if that's what you get or that's what you elect, if you have a choice, is that they could be worth nothing. Like if I could buy stock at $25, I gave an example of it being at 100, but maybe it's down to 10. That's worth. I wouldn't buy a $10 stock for $25, so there's no value there. And so, a lot of times executives and directors, key employees are compensated in stock options, and so, I saw companies trying to play a little bit of catch up here to say, hey, look, we've got your normal grant. On top of that, we've got like a special grant of stock options. And maybe instead of a 3-year vesting schedule like normal, this is only a 2-year vest. And so don't take for granted that it will always be exactly the same. It can change. So it's really important to know how much, what types, and vesting schedules for each one of your grants specifically. Number 2 would be what percentage of your portfolio is currently held in company stock, and this goes back to concentration risk, all the things that you just laid out of being a holder of an individual stock, especially at the company you work for. And I think it's important to know this, both for just vested shares that you have, but also unvested shares too. Like those, unless you plan on leaving or retiring in the very short term, like those will probably come your way as well. And like I mentioned with the RSUs, whatever happens to the price between the grant date and whenever it vests, like there's still fluctuation there. It's still as if you owned it, and then it vests and you actually do. And so maybe you think about those a little differently as far as what percentage of the portfolio you want in stock that's either unvested, like total vested and unvested, or just vested. But it's important to know, I think, both. Number 3, you also want to think about like what do I expect to receive in the future? So super common at employees of private companies, when you first come on board, they'll just give you a massive grant of incentive stock options. And after that, you might not get anything. At publicly traded companies, that could also happen too, maybe like in the form of a signing bonus, but those could be more regular and ongoing. And so is that something built into your employment agreement where you're saying, here's my cash, my salary, here's my cash bonus target, and then here's my target for either stock options or RSUs, and it'll be around this dollar amount. So that's something that we can kind of count on, again, subject to fluctuations and all of that stuff. Or is it just something that's more discretionary? Sometimes I get it, sometimes I don't. But there's a possibility that I get more down the road. So you got to know what's potentially coming down the pike that informs kind of decisions that maybe we want to think about today. what rules are in place or limitations that might restrict your ability to buy or sell stocks. So something that everyone has to deal with to prevent violation of insider trading rules and regs, which the penalties for are very serious, and the SEC is very aggressive about this, is blackout periods and open windows. So usually what a company will do is, they'll have quarterly earnings calls, and then 2 trading days after that earnings release, which then in theory most everything is out there in the public, and the market has an opportunity to digest that, and the price does what it's going to do. At that point, it's pretty unlikely that most employees have access to material non-public information. And so you'll have like a 3 to 6 week window maybe where you can place trades. And then after that window's over, then you can't. And you got to wait until the next one. And so there's like 4 times a year from maybe 3 to 6 weeks where you can trade stocks. So if you need money, in November, but your window isn't until December, like you got to be thinking ahead about that and thinking about raising cash during the open window prior. There's an extra pain here for executives, directors, and really any key employee is that is not the only rule in place. That's just one way to deal with insider trading and material non-public information. If you have information that the company or the SEC ultimately would think, hey, this is meaningful. If this were public, it could potentially impact the stock price. If I hold that information, maybe I know there's a big a lawsuit, right, that we're working through, or a massive SEC fine that's going to, I'm on the legal team and that's going to hit the headlines a month from now. Like that's material non-public information. So it's very common for the clients we work with at the executive level, they could go for a year or 2 years without being able to place trades, even in open windows. So that's no guarantee. But that's the most common restriction. Others could be, maybe if you're an executive, you have to have a certain amount of company stock just as part of a condition of being an executive there, as a way to kind of align your personal interests with shareholders. Vesting schedules we talked about, you can't do anything with it until it vests. And so what kind of rules and limitations are in place? Really just kind of logistical questions around how can I make decisions around my stock and when can I do that? So those are kind of the logistical components, or, where am I today? What do I have? Beyond that, kind of the softer side, I guess, or the non-number side is, you got to be thinking about how strong is your sentiment to either sell stock right away, hold it, accumulate it, and really dig into what the key drivers are behind that. I think a lot of times it's inertia. We tend to assign more value to things we already own than they actually are worth. And so what is that? Is it, would I buy the stock if it were on the open market, or am I just keeping it because I was awarded through equity comp? What goals am I using to fund it? If it's a short-term goal, not ideal to have in company stock. That should be in cash. But what's the time horizon? How much money will I need for that particular goal? Just assign specific goals to your money. I think that's really important. Would you be more distressed by hanging on to company stock, so like not selling it and then it drops by 70%, or selling out of it and then it goes up by 70%? I think that human nature kind of has us backwards on this one, where fear of missing out is a reason to hold on to the stock. But actually research shows we hate losing twice as much as we love winning. And so we end up keeping it for the wrong reasons and then feeling the pain a lot harder than we would have if we did indeed miss out. How would my financial trajectory or my plan, right? How would that change if company stock goes way up, if it underperforms, if it goes way down? So this kind of gets to what's your ability to take risk there. And then you need to think about tax implications. So, the rules across these plans are all different. If I sell an RSU, that's different than exercising an option. So what are the implications of all of those? How much and what types of additional income can I recognize before phasing out credits or deductions or subjecting myself to higher marginal rates? And I think all of this kind of feeds down into really one big question of how much of my portfolio should I have allocated to company stock, given my risk tolerance, my current financial position, and my future goals. And then if I have too much, how quickly should I plan to unwind that? And how should I get that done? Like what stocks or what grants should I sell out of first? And it just takes a lot of work to kind of get there to process through. Yeah,
totally. And I mean, all these considerations you've been describing, as people are listening along, they're probably thinking these are great questions, but how do you put it into something that's tangible and actionable?
Yeah, I think that the key here is taking all that information and using that to create a systematic framework that's not driven on like for making decisions. Let me start that over again. I think the key here is taking all that information and using it to create a systematic framework for trading company stock, and not based on emotion, not based on, well, I think the stock price is going to do this, or I couldn't possibly sell, it was up here earlier, or, just kind of gut knee-jerk reactions. And you need a disciplined, proactive, rules-based approach. And so this is something I just refer to it as a company stock management plan. You can't really Google that anywhere, just a Derekism, I guess. But here's the rules that we have in place that are going to guide decisions regarding, here's the company stock I have today. What am I going to do with that? Here are the grants that I have coming down the pike in the future, either that haven't vested yet or what I'd expect to get in future grants. And then being able to make decisions around company stock in a way that's integrated with the rest of my investment strategy and rooted in my overall plan. And ultimately, it should be a reflection of who you are and the things that matter most to you, and your willingness and ability to take risk. And I think it's especially important. This is really important overall in investing, but I think it's really important with company stock because investing is emotional. Investing in company stock is extremely emotional. This is like it's a representation of your blood, sweat, and tears. And look, I get it. I'm a shareholder at Plancorp. I'm very passionate about what we do here. I very much believe in the company. I am all in on Team Plancorp. And emotions aren't bad. In fact, I think they should be acknowledged and honored and accounted for, not just suppressed and ignored, because that's probably a recipe for disaster. But I think the key is we just don't want them driving the bus. So what can we do to create a framework that takes that into account, but just makes decision-making a lot easier? And that's where this company stock management plan comes in.
So all these things that you're talking about, Derek, I've seen how this all looks using a proprietary tool and process that we go through with our clients. I'm actually going to put a snapshot of it in the show notes at thelongterminvestor.com. You and I are both looking at it now. Just kind of as a final point here before we leave some people with the next step for the advanced information, maybe just go through the different steps here. And again, if you're listening, you can go to thelongterminvestor.com. I will have this and some of Derek's excellent other graphics there for you to follow along with him.
Yeah, sure. I think the key is putting this down in a place and that you can refer back to, and you've got conditions here that need to be met, and if they're not, then we need to do something about it. And so the first one, I really think the first two all of them are important, but the first two I think are kind of the core foundational pieces of this. So the first section is, how much invested grants that we have today are needed for current cash flow. And I think most of the time that answer should be zero, it's not, if I have a down payment on a home here in the next, 6 months or so, like next spring, I wouldn't want that in stocks. I wouldn't want that in bonds. I mean, did you see what bonds did last year? Like that's not, safe like, a cash account would be. And hey, by the way, cash is actually paying something nowadays. So that's exciting. So that should be in cash, and certainly not in an individual stock position at the company you work for. Now, if this is a longer term goal of, hey, this is just part of money I'm sending out for retirement, or maybe funding college, over the next 4 years, but if I had to, I could sell from somewhere else. Like, okay, but you just don't want to be leaning on that for an extensive current cash need. So most of the time should be zero. So if it's more than that, then we need to do something about it. We need to sell enough to generate cash we need for current goals and cash flow. The second one on this list, it says POS, which stands for probability of success, with a 70% permanent decline for all grants. So this refers to our financial independence analysis, and this is how we tie everything into a bigger picture financial plan. So all of that really good data that you ran through. From JP Morgan, we use that in the context of a plan to say, all right, we're going to take the value of all of your grants, and that can be RSU, stock options, whatever. Assume the stock price declines by 70% and it never recovers, which again is not that uncommon. What happens to your plan? And if it becomes constrained, I've got here, if it's a probability of success of 70% or less in this example, then hey, we need to reduce the amount of company stock you have, because your willingness to take risk might be high, but your ability to take risk also needs to be there. And we don't take the average of the two, we need to take the lower of the two. And so for other people who, they've got half of their money in company stock, I look at that and think, no way. But if the plan works and they know what they're signing up for, more power to them. So you mentioned 5 to 10%, Peter, of, really shouldn't have more than that in an individual stock position. I think with equity comp in particular, this is one that, like, for someone, 5% could be too much, and 50%, although I think that's wild, maybe it works, and as long as they know. So that's where the context of the financial independence analysis really comes in handy, is kind of stress testing with this. And then from those couple of things and all the questions we'd asked before, we can then set parameters around, I want my total vested grants to be 10% of my portfolio or less. I want all of my grants, vested and unvested, to be 15 or 20%. Like, don't anchor to any of these numbers, just giving examples. But in that example, like if I hit 12 or 13 because the stock had a really good, day or, month or quarter, then I need to sell some to get back below that 10%. Has nothing to do with what I think the stock's going to do in the future. There's nothing predictive here, but it is proactive and well-defined. I can then think about the total value of my vested grants being below a certain number. Maybe you're not comfortable with $1 million or $500,000 or more. And then the last one here, I'm going to kind of save for the next episode, but this refers to a strategy to think about when to exercise stock options versus not. And so if your intrinsic value for a stock option is above a certain percentage, then, hey, we're going to go ahead and exercise it at that point. So the philosophy is here, if any one of these are triggered to where you fall outside of these kind of tolerance bands or thresholds, then we need to do something to get you back within them. And it just removes emotion from the equation. It makes decision-making very easy. And it's not autopiloting to the extent contribution election one time and then you make 100 good decisions after that automatically, but you can at least have the framework there to make that an easy decision that just comes down to execution. So I think it's really, really important, and this is a great way to do it. The last one on here, I'm going to have to save for our next episode. It was intrinsic value of your stock options. So this is just referring to a strategy for knowing when to exercise stock options versus not. And so the point of this altogether would be, if any of these thresholds are broken or we go outside of them, or then we need to take action and to get back below a certain percentage or dollar amount, or to exercise options if it makes sense to do so. And having a quantifiable way to do it, I think, is really important, and this is kind of a snapshot into how we approach that here.
What a great cliffhanger, Derek. It's amazing, because you are going to be back on the show next week to talk about the more advanced executive compensation planning strategies. We hit a lot of the basics and we did start going deeper, but in the next episode, we're going to talk about some stuff like the advanced deferred compensation planning strategies, the frequently missed opportunities, how to make contributions, distributions, investment elections. We're also going to talk about some advanced equity compensation planning strategies, such as deciding when to exercise stock options. I think that's what you're referencing, this intrinsic versus time value concept that we're placing a little teaser on there. And then some AMT planning for incentive stock options. You referenced AMT planning once before, maybe twice before. There's a lot of little nuances, all the reason that we're going to create a second episode next week. And finally, I think we're even going to get into the very niche topic of 10b5-1 plans. So if you've enjoyed this episode, make sure to tune in next week. And if you're watching us on YouTube, like, subscribe, comment, do all those great things that help other people find this very valuable information. Derek, thanks so much. I guess we'll all be seeing you next week.
Looking forward to it. Thanks, Peter.